Ladies and gentlemen, welcome to the Traders Committee meeting here today in lovely Warsaw. The world is different to the one we have seen in our last IREPAS in Athens. Quite some changes, and of course the discussion on the 232 section is ongoing and is surrounding the whole discussion here. So agreements have been made already between America and some countries like Argentina, Brazil, and the third one was Canada? Canada. And but they are still subject to final consultations, and it seems that those countries have to give away quite an amount of quotas and tonnages which they can import into America. So meanwhile, the whole world is in a debate of what is going on with America and is arguing whether certain tax rates are fair, if America is really unfairly treated, and so on and so forth. But one forgets that the whole discussion really started initially with the United States using the national security as the main reason to exclude imported steel. And so this is actually the real reason, and we have a trade debate rather than a national security debate. So in return, we see now that also the Europeans are coming up with safeguard measurements. At least investigations have started. There are all kinds of rumors what will be the final outcome of that, duties, quotas, and an end. And honestly, we believe it's way too early to really determine any direction. But we've also heard now that Turkey is investigating to what extent their economy is being hurted by imported steel and other products. And we are now in the middle of a real trade debate and kind of a trade war with, even with a domino effect that, of course, every country who is in a certain way connected with that they also try to protect their own market. So, as I said, the domino effect is there, and we probably will see other countries also looking for protectionism. China is already in debate, and we learned that a high-ranking delegation from America is already on its way to China to discuss seriously about that. So certainly today in the panel, one of the key issues are safeguard measurements. And since none of us will have the crystal ball, it's definitely only a kind of personal opinions which we can share with you guys. And so we will head on with a couple of questions which we have got from the audience. And what one can say is that the United States, what we have learned yesterday in the preparation meeting, is producing roughly 5.8 million tons of rebars domestically versus an 8 million euro consumption. So according to this, there is definitely a need to import rebars, and even if they would increase the capacity utilization by a few percent, this may reach another 500,000 tons, but all in all, there is definitely between 1.5 and 1.7 million tons which America has to import. So if they have to import it, and if they put a 25% surcharge on top, that means that the industry has to pay for it. So if the $1 trillion investment program, which Mr. Trump promised in his presidentship, will really become true, but of course it will take years before it really starts. But then, of course, the demand for reinforcing bars will further increase, and the demand for imports will increase further, and it will make the investments even more costly. So, in return, we also see that Turkey has exported approximately 1.4 million tons in 2016 to America, and in 2017 only 650,000 tons. That means they reduced already a lot, but probably under the threat of the upcoming safeguard measurements. So in the European community, for example, in 2017, Turkey has exported all in all roughly 400,000 tons of rebars to the EU, and to Canada approximately 270,000 tons, and it has to be seen if Canada will also follow trade measurements. So if all this would fall away from Turkey, that is quite a massive amount of exported steel where they have to find new homes for, and this is definitely not easy in these days. So Turkey roughly is producing 16 million tons of rebars, not 16?
12.
12 only.
Turkey production.
Turkey production.
Maybe
I thought 16.
Yeah, consumes 12.
16 and roughly 10 million domestic consumption these days, right, which, according to some Turkish participants here, is really, really, really not sustainable. The 10 million is an all-time high level, and probably more realistic in sustainability sense is roughly 7 million tons. So it's a boom right now, which probably cannot be continued for years. So another couple of million tons have to find a home anywhere. So going from there, let's start with the first question, which came from the audience. And well, as not a surprise, it's also in conjunction with this. What is the exception now that Trump has extended any definite action by 30 days to the European and other participants? So, Don, maybe you comment on that?
I don't think anything will change because from what we understand, the 30-day extension doesn't mean anything because Europe is a complicated group of countries. They cannot make a decision that fast, and they do not want to make decision under threat. So I think there will be no real decision coming out in 30 days. So we expect either this to be extended for another 30 days, which is helping the U.S. domestic industry. As long as they keep this uncertainty going, then there will be less product coming. So that's maybe part of the game. But there's really nothing definite what's going to happen in 30 days. I don't think there will be any.
Any comment to that? And we continue with the second question again on this trade case. It seems like the U.S. administration is not willing to grant exemptions to Turkey. If so, the rebar importers and distributors in the U.S. will be looking for alternative supply sources. Given the existing anti-dumping duties and the capacities, who can step in? European mills, question mark? Well, we have seen already that right after the exemption of Europe, the European community from the 232, some European countries have exported bigger volumes of rebars into America, even quenched and tempered material, which is usually quite unnormal for that market who's requesting blue steel, so air-cooled material. Nevertheless, I have a big doubt that European mills, or let's say the mills may do that, but if the trader and the importer is going to continue that now with another extension for just another 1 month, because the risk of falling off the cliff is relatively big. On the other side, with the price situation for rebars and in comparison to the price situation in Europe, some importers may even be ready to gamble on 25% duty. If it comes, okay, then he is at break even. If it doesn't come, he has 25% in his pocket. So,
well, if you guys want to look at historically, the Turkey and Mexico was the major exporter of rebar to the United States. But then there was an anti-dumping against Mexico, which put them out. And on the West Coast, we had material coming from Japan and Taiwan. China has been out for many years. So if you look at what's going on today, we have the 25% additional duty onto Turkey, which already has an anti-dumping. We have the same goes for Japan and Taiwan. So really what's left is only Europe that doesn't have any duty, but has a threat of duty. So what, of course, the traders have done is take the risk and brought the steel from Europe, and hopefully this will continue. But in the long run, is it sustainable? No. There is no way you can get million-plus tons from Europe alone, which automatically means that U.S., yeah, they will increase their capacity, but the capacity increase is not going to happen overnight. So in the next 6 months or so, you will see that either Europe will open up, even if it opens up 100%, there will be still not enough steel in the market, so the prices will go up to a point where the Turkish steel can still come in with the anti-dumping and with the 25% in it. So long run, I expect the U.S. steel prices to keep going up.
Michael?
It's impossible to forecast what's going to happen with the pricing in the United States because we don't know what the rules of the game are as of yet. Probably sometime at the end of June we will know. I think it's too early to think that it's going to be rectified by the 1st of June. The demand situation in the United States is very good. There are a lot of people who have a lack of material that they can transform, so they are applying for exemptions with the United States government. In the month of February, I recall reading that the United States Commerce Department guaranteed to have enough people on hand to judge exemptions up to 7,500 within 90 days. 2 weeks ago, it was announced that there were over 10,000 applications for exemptions from customers buying 50 tons per month up to 5,000 tons per month. And all of these exemption requests are made by people who have never applied for such an exemption test before. So obviously, I would imagine that automatically half of those exemption requests are not in the correct form for the U.S. Commerce Department to deliberate on, and they'll probably be sent back and be requested to submit new ones.
But
so,
Michael, I'm going to say this. The exemptions that they're applying for are for the critical cases where you have specialty steel making certain products. You have to be a manufacturer of something that you cannot get that steel from domestic sources, then you apply. Rebar is not one of them. I doubt that they will allow any one of exemptions to the rebar. It will be mostly for the other types of steel.
I'm not talking about rebars. I'm talking about other long products. There are a lot of customers in the United States that have only been importing. They don't know even how to buy domestic, and these people are also applying for exemptions. They can't, they don't have allocations and so forth. So it's going to be very difficult for a small and medium-sized enterprise in the United States to navigate the bureaucracy of Washington, D.C.
Even we applied for, even we applied for the extension, I mean special exemptions for the specialty steel, not for rebar, because that we know we had a serious deficiency. But for rebar, maybe. I doubt it.
Another interesting question is what is going to happen if, for example, they would put a quota system into place and Europe, who was traditionally not very active in America over the last years, would have a very, very low quota in this case. So that's also...
Quota is already filled.
It's already filled.
They already shipped like more than
more than
what they have shipped last year. So quota is gone. I don't think Europe will, accept the quota because, like I say, it's already gone. I mean, the Koreans accepted quota, and the quota was the 70% of what they shipped 3 years prior, and they just realized that it was retroactive from January 1st of this year, which means their quota was full for majority of the products that they were going to sell. So the main product that Korea sells to the U.S. is pipe, and the quota is already full, so they cannot sell anything.
Any comments on that? Or another question, or?
Yeah, go ahead.
You said about the Korean quota.
Yeah.
Once it was implemented, it starts to be effective, right?
No, January 1st. I mean, they thought that way. It didn't work that way. It was retroactive to January 1st, which basically took off everything that they could sell. Yeah.
Any other question or comment to that? So then, we agreed to skip questions 3 and 4 because we really had no idea what was meant. So we started with the raw material part. Question 1 was possible medium-term effects on Section 232 tax application in USA in regard to export scrap availability and scrap trends. Michael?
There were two purposes with the Sections 232 that was announced by President Trump. One was for national security, and the other one was to allow the American steel industry to reach levels of production that were sustainable, and that was listed as 82% of nominal capacity. And so if we consider what the goal is, if they are going to be successful, it means that the United States steel industry will consume more scrap than they did before. So if we consider that the U.S. steel industry produced something 67 million tons last year, and if they increase the production by 5%, then obviously there will be that amount of scrap that is not available for export. However, the demand and supply situation of scrap is something that is very difficult to forecast, and it depends how much goes for export at higher prices or lower prices. And most people in the United States considered that scrap would go up after this announcement, but it went basically sideways, and this past month it went sideways, minus $10. And what's going to happen now on this Thursday when the scrap contracts are finalized formally, nobody really knows. So the amount of scrap earlier today in the presentation that we received seems to be growing at a higher rate than the amount of steel production. So if there's more supply, then it would mean that prices might go down, and especially if major scrap importers such as Turkey were to reduce their sales in the domestic market by 1, 2, or 3 million tons over the next 12 months, maybe that would compensate for what is extra needed in the United States. So we don't know.
I was just checking the statistics, and with the ITC basically, and I realized that U.S. did increase their production actually from 2016 to 2017. 2016, our production was 78.6 million tons, and 17 was 81. Now, 81 million ton, we were importing 34 million tons of steel. So the administration wanted to increase our capacity utilization from 75% to 85% by about 10%. So even if you increase that by 10%, you're going to go to 88 million tons, you still have a serious deficit there. So I don't think it's going to change much, really, with this 232, related to 232. But the consumption in the U.S. is increasing because of the new measures. So I think the economy is doing well, and so the consumption will increase. So I would think that a majority of the consumption that's increasing is scrap-based, electric arc furnace basement. So I think that you will see more scrap to be used domestically, and there will be less scrap to be exported to Turkey or anywhere else. Yeah. But probably there's enough scrap in the world to supply. I don't think there's a shortage of scrap.
Yes, sir. I would like to also make a comment regarding the scrap. As we all know that Turkey is the biggest scrap importer in the world. So last year in 2017, Turkey imported 21 million ton scrap, and which is the monthly average is 1.7 million ton monthly. Then the scrap that Turkey imported from US was 3.8 million ton. So which is monthly is 315,000 ton. So when we look at the figure of 2018, between the January and March, the total scrap cargo that was imported to Turkey was 5.3 million ton. So which is averagely monthly 1.7 million ton. So compared to 2017, is nothing changed. And also the quantity that which was imported from USA within 3 months in 2018 was 990,000 ton. So monthly, which is 330,000 ton monthly basis. So again, compared to 2017, there was no much change. But we should not forget that this is the first 3 months. The affection of 232 before the affection of 232. So we are expecting that the scrap from US to Turkey is going to come down.
Yeah, on top of that, we've heard in the report today from Mr. Ma that it is expected that even China is going to increase the scrap demand by something like 40 million tons in 2018 because of new blast furnaces, electric arc furnaces. So that is also a huge amount which will be coming to the market as a demand. So yeah, scrap seems to stay very much
demand, but really I don't want to excite any scrap people here, because there's enough scrap in China as well. China is becoming industrialized. As the countries get industrialized, they use more, produce more scrap. So pretty soon you will see that China for years have not been importing much, and probably will continue not to import much. Export, I'm sorry.
Let me also give you the figure of China. In 2014, 2015, and 2016, the total Chinese steel scrap export was almost zero. Then the export started in 2017, especially starting with the second quarter. The first quarter of 2017 was almost zero as well. So end of the year, it was about 7 million ton exported from China to Southeast Asia, all over the world. But since the induction furnaces is going to be, the production is going to be cut in the induction furnaces, and new electric arc furnaces are coming up, which is, we are expecting 40 million ton. So the China is not going to be net scrap exporter. So we'll be consuming mainly in the local market.
Exactly.
And even it might be some shortage as well, that what we are seeing also for the billets.
Will become net importer or exporter?
No, it's not going to be exporter. So we will consume more in the local market. Yeah, because as you know, whenever China started to export scrap, it was usually in the Southeast Asia area. Even it came to the Gulf area as well, to Turkey side as well. But we are not expecting any shipment from China to Gulf area, to Middle East area anymore.
Any comment, question to this?
Because one of the reasons is the usage ratio of the scrap usage in the blast furnace also increased as well. And we are expecting this year that the usage, the increased ratio of the steel scrap in blast furnace to be used 121 million ton. So
Increase.
That's right. That's going to be the scrap that which is going to be used, 120 million ton.
I wouldn't know why they have to increase the usage of scrap in the blast furnaces.
Environment issue.
Okay, maybe I don't know.
To reduce blast furnace.
That's right.
No.
Blast furnace usage of the in the blast furnace because of the government decision regarding the environment issue, which was started in the 2017 last quarter. In 2017.
Okay. So let's come to question number 3 again under raw materials. What are the expectations for iron ore prices given the output levels in China? So yeah, you commented that already, but
okay. In this year, in 2018, we are expecting the Chinese production to increase about 18 to 20 million ton. Because as you know, there's going to be some production cut in China. The production cut is going to be about 9.17 million. It's about 9 million ton production cut it will be. But there is one, also the production increase because of the facility upgrading, which is going to be about 8 million ton. So this year, we are expecting total steel crude capacity in 2018, 849 million, 850 million ton. So compared to 2017, it was 831 million ton. So we are expecting 18 million up to 20 million ton production increase in China. But we are not also expecting this quantity to be exported. So what we believe that the China, especially for medium term, is not going to be a threat for the export market. We'll be consuming locally, more locally.
This morning, the gentleman was saying that China was going to produce, actually produce 737 million tons and then it's going to produce in 2019 722. So it's going down, he said. But it's all confusing. I don't know.
so in summary, would you say, from the Chinese perspective, that iron ore prices to stay stable, pretty much, or even a chance to go down?
The thing is, what we believe that for the short term, we don't expect the iron ore price to come down. The reason is we see the sufficient demand in local market. Even, especially east part of China, we see even some shortage on the billets, raw materials, and even the mills in east part of China, even they've been getting the delivery from north part of China, which is in Tangshan area, even paying for $19 truck transportation. So here, the local market in China is doing fine. And since there is a demand, so we don't expect any iron ore price to come down.
Well, this morning, Mr. Peter Marcus, maybe he was saying that the price of hot rolled coil is going to go down to 565, if I'm not mistaken. So it's 700 level now. So the price is going to go down in the fourth quarter. So if the prices are going down, what do you expect? Do you think the iron ore price will stay the same? It's not. It's not possible. If that, I'm assuming that prediction is true, then you will see both it's going to force the scrap and iron ore prices to come down.
Especially for the hot rolled coils, we don't see any chance the price to come down. The reason is, since last 2 years in China, there are some investment for the galvanized producer. But There is no in the same site. There is no also the increase on the hot roll coil producer. So that's the reason that there is a demand for the hot roll coils, and we see it on the prices of the hot roll coils that is not coming down.
Peter.
Although,
Yeah, I'm sorry.
although some of the products recently it came down, but always the hot roll coil prices was stable in the level of 595 level.
Can I ask the comment from Peter, maybe? Can you just comment on it, on the scrap? And we talked about the hot roll coil this morning. Can you please comment on the effects on it on the scrap and or iron ore? Yeah, I have to wake him up. All right. Do you want me to repeat that question?
Well, we had a graphic where you have, when you take the price of iron ore and multiply by 1.6 and add a cost to convert from sinter feed to sinter feed, and you take coking coal times 0.9, there's a formula comparing the derived cost of iron ore and coking coal for the blast furnace and therefore into this BOF steelmaking furnace against the cost of steel scrap. And you'll see in the graphic there are enormous swings in these numbers. Sometimes there's a major advantage. The scrap can be $80 or $90 undervalued or 50 or more overvalued. So I would say you have once you are at an extreme, very high or very low for scrap, then you have good odds it'll correct. But otherwise, if you're kind of in the middle, there's no secret formula or way to be certain that scrap and iron ore are going to move that closely together. It's a different world.
So are you suggesting that when the coil price or steel prices go down from 700 to 575?
Well, to 525.
525.
First of all, the
even
price
lower.
today is near 600 to 620.
Okay.
FOB, the port of export, it's not 700. The forecast, it will go temporarily to 700 because there's a boom in China, and because they had production cutbacks and they're catching up, so their exports on the world market for another couple of months, or for now, their offerings are more subdued. So we have this non-recurring condition, maybe, seasonal demand going up. But then by the summer, the production is too high everywhere. And, the party's over. Let's say the party goes from great to fair to good. That's not so bad because home market prices are fine. Now in Turkey, the dilemma, condition, circumstance is that the price in Turkey is very much a function of the world price. You have in Turkey a huge number of producers, competitors of rebar, and they all want to maximize output. So in Turkey, this is one of the few countries where your long products seem to move directly with the world market. There's not what you call stickiness between the world price and the price of home. In hot roll band, the old Erdemir, it's a little more sticky. But so Turkey, you're a market-based pricing system, very dynamic, very much driven by scrap prices. So if China is by chance exporting a lot of billet, which is called square bar or something with chrome in it, and it becomes very cheap. If that in fact happens, your industry here will take advantage. So what I heard, which is very discouraging for Turkey, is you have, with your weakened currency, you're having a rise in cost. Your costs, let's say, are average. You have less demand than production capacity. So it exports. So it's incredibly dynamic, export-oriented industry, running into varying trade barriers at times in different parts of the world.
So you would expect the prices in Turkey to come down as well?
Right.
So if the Turkish prices are going down, which reflects to the world...
But if you want to figure it out, the world price goes down, let's say, by $80. Yeah.
So
you would then have to have the price of scrap would have to go from, I guess it was 370 or 80, and now they think it's down to 355. So in theory, the price of scrap comes down to 300. And you add $180 for the conversion, that's $480 to produce rebar, $490 or something to produce hot rolled band. So, like elsewhere, that's not so bad.
No. And with that price decrease in Turkey, you can expect that even with the 25%, Turks can compete in the U.S.
Well, if the U.S. mills keep their price or raise it, you're going to have existing exporters and new exporters happy to pay the duty at the port of export, and in the U.S. will be having a lot of imports of rebar and of hot-rolled band, things like that.
Yeah, they have to. Thank you.
It's a pleasure.
Good.
Any further comment to this point? Then we proceed with the next question. Billets versus scrap for the electric arc furnace and electric arc furnace versus blast furnace in terms of production cost. Who do you like for the next 6 months?
You don't like, but which one is
worse?
Cheaper? Yeah. I'm assuming, blast furnace is going to, definitely have an advantage over the electric arc furnace, and it's been going on all the time. I mean, I don't think that the initial cost of obviously, building a mill to produce blast furnace is much higher, but other than that, the production. If you just look at the production, the blast furnace is much more advantageous.
I think the difference in between the two is becoming smaller, and that if you look at the variable costs of buying scrap or buying all the materials for a blast furnace, it is more heavily dependent on which region you're located than the actual production costs. So, for example, the question says billets versus scrap. All of the large integrated long product producers in Turkey consider that it's more advantageous to buy scrap and produce their own billets than to purchase billets, because, as Mr. Marcus pointed out, that let's say that the production cost of billets in Turkey is around $480 or $490, and the selling price, offer price from the Black Sea today is $520, $525 CNF. And the people who are buying the billets that are exported from Black Sea to Turkey are independent rolling mills without possibility to make billets. And the Turkish mills that are making billets are not inclined to sell billets at such a low price to the domestic market.
So if I could add in something else, traditionally, scrap is very price volatile. Iron ore is somewhat less, and coking coal is much less. What you have in coking coal, you've had the price ran up. You have a major new supply of coking coal in Mongolia, about 25 or 30 million tons going to China, and you also have in Mozambique. And there's been some improvement in capacity. So you would think that since pig iron production doesn't vary that much, that the price of coking coal could revert to its historic pattern of being less volatile. Now, pretty much in iron ore, you have the low-cost producers making a lot of money, and you have these mammoth inventories at the Chinese ports, and it appears that your production in China this June or July may be high, it may reach an all-time high and never hit it again. So that's an argument that the iron ore is not necessarily, and even iron ore hasn't been as price volatile lately as before. And to have a huge price spike, you have a shortage, or I mean a physical shortage. Where is there a physical shortage of iron ore? None. So you come up with a conclusion that the scrap price will be entering a period of much higher volatility relative to the other materials. So you have the opportunity to spin that forward as you have futures markets that are liquid to start hedging ahead on the scrap price to stabilize the finished good prices. And, you know, in my biased opinion, this is a remarkably spectacular opportunity for those in Turkey depending on the price of scrap, because you can't predict the price of scrap. It's a material used last. You have 2 billion tons of steelmakers metallics, and you have like 300 million tons of obsolete scrap consumption. So you have the tail wagging the dog. It's consumed last. So you can never have confidence, maybe you folks do, I don't, that you can make an accurate scrap price forecast. So you should go after that futures thing and find ways to hedge, and it can do wonder. You have another problem. Banks hate the steel companies. Why? In part because they don't have good profits often, but because the prices are volatile. The steel company can only get a loan, an inventory loan, based on its balance sheet or based on its equity and size. It can't borrow an inventory except at a high price. Once you can hedge your inventory, you can get bank loans at a reasonable price. So in Turkey, I mean, that's incredibly important.
Mm-hmm. Wise words.
Okay. So any further comment to?
That's the next page.
Here's what we're going to do. We're going to take two people on the audience up there on the head table, and for 1 year you're going to take my job, and I'll take your job. We'll switch jobs. We'll see what happens.
I don't think I can take your job ever. You know, I'm unfortunately in a different position, but really, my job is not to make predictions on what's going on going forward, because we really work with short-term, 3 months into, or maximum 6 months predictions. We are traders, and we are traders. Our business is short-term, so we don't really look what's going to happen in 2019. If the prices go up, we increase our prices. If the price go down, we lower our prices. So life is good on that sense. We're not exchanging our position. Your job is tough because you really have to make predictions in a world that is constantly changing, and there's so many factors affecting, and then...
I have to be right.
Yes, and that's tough. So I don't want your position.
Well, we have three questions here about financial forecasting and hedging.
Yeah. So let's start with number one. Again, a question from the audience. How do you currently manage your commodity risk and P&L, e.g. spreadsheet system and so on? So, yeah.
Does somebody in the audience want to explain how they're hedging their risks, or if they are not?
No, I didn't understand the question either.
Yeah. So maybe we continue then straight with question number two. Implementation examples of forward future markets usage for hedging and physical billet trade, and ideas, examples about index-based or surcharge-based billet contracts. So
I think these questions are coming from LME Group, huh?
Probably.
No, we don't hedge.
There are people in the United States who are buying, hedging against a scrap contract or against a hot roll coil contract, and then using that to hedge something that is quite similar in nature in their physical business. So, for example, the CRU system, CRU, is used heavily in the United States now in order to price hot roll coil.
Okay, I would say in the United States, the CRU price is used to price coil, and maybe the MEPS price in Europe. And you can, with a trader in the United States, you can sell forward, who knows, 5 months a certain quantity at a price.
Yeah.
But what you can't do is change your trade. Once you have a liquid futures curve, you can go forward a month at a very low cost. So you can make the hedge, but then you're locked in. You don't have liquidity. You make a one-time decision and you work with your customer, but that's not really futures trading. That's having a 3 or 5 or 6 month hedge at a price. You don't have liquidity. That's no good.
Willie. Hello, over here. I've managed to grab a microphone. Julian Verdon, STEMCor. I didn't fully hear either question, sadly, but I think what the questioner was driving at is how can we all in our business better manage risk. And I think the new contracts that the LME have, and as was just said, are available in the States more on hot roll coil, do enable trading companies and stocking companies and mills to sell forward or buy forward their positions, and thus mitigate the risk of substantial price movements. One of the issues, which is why it's taken a bit more time to get the traction that it has on metals such as aluminium and copper, is the low price of steel compared to those products, compared to the cost of doing the transactions. We need greater liquidity to reduce the cost in that. So the cost of making these transactions, the spreads are still somewhat high, but we certainly, as STEMCor, have used hedging tools to manage our either short or long risks, and I'm sure that other trading companies here or stocking companies have done the same. And we know that mills, having said that they don't sometimes wish to utilize hedging instruments because they perceive it as a risk to their sovereignty over pricing control, also do use hedging instruments because you can see their activities on the various exchanges. So I'm interested to hear whether anybody else on the panel or otherwise is prepared to even admit they're using hedging.
Actually, what you said makes sense. For the mills to hedge what their products makes sense, or on the buying side makes sense. But for the traders, we are, like I said, we are very short term, and most of the time we're not really trying to decide what we're going to happen in 6 months from now. And the 3 months from now, we always tell our customers, basically when they buy from us, they're kind of hedging because they fix the price for material that's going to come in 3 months to 6 months. So in a way, they're hedging by buying from the traders. But we as traders, the only thing we hedge is the currencies. I mean, if we're selling in different currency, we have to hedge, and that's the only one that at least I use. Please.
Okay. If you look at the hot roll, to have an active market, you have to have buyers and sellers. If you're in Europe, how many hot roll band sellers do you have? 5 or so, maybe. Europe, USA, 5. So the sellers don't want to participate because they believe if they get involved in the futures market, it's even going to be worse for them than depending on a price index that's published once or twice or 3 times a month or 4 times. They're wrong, but they fear it. And the mills are the only sellers. So you don't get the liquidity because the sellers won't play, okay? Now, if you look at scrap, every processor is a buyer and a seller. So you have an infinite number of sellers, an infinite number of buyers. So scrap, in theory, has a foundation to take off in volume and become liquid to a much greater degree, perhaps, than hot roll band. And you as a trader, you just made what I consider to be a narrow-minded statement. You said all you can do is you buy and you sell. You're living in a week or 2. If you can get into hedging, you can make a deal for 3 months with your customer. You can hedge the scrap, you can hedge with him, he works with you, and all of a sudden, you're offering your product on a longer-term basis as a trader. When you can hedge, it's a miracle for you. It's your savior. The trading business has gone to hell because of the spread of information. Look at the diminishment of the trading. So the futures market can open for traders an opportunity to be better positioned. What do you think of that?
Well, I'll just give you one example. You have a customer in Philadelphia, you sold some futures, and then you go ahead and hedge it. Time came when you have to deliver, you really have to buy and do it at that time. Typically, for the time that you need for the production and shipping, that's about the same time that you have to deliver. So really, you have to basically buy almost simultaneously as you're selling.
That's because you don't have a liquid curve. Once you have liquid curves, that problem goes away.
So we really can't make that, at least I'm talking about my case, and I'm sure everybody else is different, and I'd like to hear your suggestion.
Julian, I think, sorry?
Go ahead.
Julian, in Stemcor, billet had been traded as paper, as I remember, and I remember the discussions also on rebars to hedge and to make future business. The problem in rebars, especially in Europe, is, as Don said, we have to physically supply. We have to provide the steel at the end of the day because the cut and bender, the construction company, needs the steel. They don't just need the hedging. So where to get it from? You have to get it from a mill which has the homologation the customer is looking for, the sizes he's looking for, the lengths he's looking for, and that is such a picturesque combination that it's almost impossible to hit exactly that demand from this particular customer. So
let me say another thing. You have in the United States, in rebar, and much of it, an oligopoly.
Sorry?
When you have an oligopoly, you have a few sellers. What they will tend to do at times is reduce volume rather than reduce the price. So they set the price, which means you don't get the action and movement in the price that you might get in a competitive market. I don't know Europe well. Maybe you have the same condition. So that's not, and when you have billet trading, you have a certain amount of public knowledge, but often billet is from one producer to another producer, and they don't need to report the price at which they're buying and selling. So you don't really have the size of market in billet to create as easily a liquid futures curve, because too much of it is done secretly. So billet is not a natural product. Scrap, which drives the billet price, is a much more natural, fluid contract. You take the scrap trade of 90 million tons a year and the consumption in the individual countries, and then you take the products outside of China whose price is determined by scrap, and in each one you have a buyer and a seller. You have a scrap market of 500 million tons or more, many, many times what you have in aluminum, copper, nickel. So you have the basis, you have a mammoth market. The scrap, in theory, works, and the billet is not as easy.
Peter, really what Willie is saying is exactly how it is, because when you talk about even rebar, which is probably one of the bottom lines in the product range, we have different qualities, we have different sizes, we have this, you can't do that. But as you get down, let's say to billet, more commodity item, yes, it can be done. But and as you go down further to scrap, it can be done, but it can't be done on rebar.
No, the reason I don't agree with you, once you have a liquid price for a product, you can then set the price of the higher value-added products as a ratio to the base price. So if you have SBQ bar that normally sells at $85 a ton more than billet or more than whatever, you can set your price for the higher value-added product as a ratio to the liquid price.
Nice theory, but it doesn't really...
It doesn't work.
It doesn't work, and if it did, people would have done it. If you look
it doesn't
around,
work because you don't have a liquid market yet.
Out of this?
Once you get a liquid market, it'll work.
No.
That'll be your savior. You need a liquid market.
Well,
but I remember some 20 years ago, you said already that all the steel traders will disappear in the next 5 years because all the jobs will be done by computers, and you punch in a number and then you hedge it. So I think it's a bit more complicated, and I think that's why we are still sitting here around and discussing. And take, for example, now the latest, what we are discussing is Section 232. I mean, even if you have a hedge, yeah, and it may work on scrap, but all of a sudden you are not allowed to sell any rebars anymore to America subject to a 25% duty. I mean, how do you want to hedge that one? Maybe there is another vehicle, but it's not that easy.
I mean, when Enron came with this idea, Peter, when Enron came with this idea, they invited us, and I listened to them, and I looked and said, wow, what a nice theory, but it's not going to work, and it didn't work.
It didn't work.
But they had physical inventory. Didn't work among its problems. Enron had physical inventory sitting in depots.
But you have to have physical inventory to back up, my friend.
Yeah, and this physical...
No, you don't.
And this physical depot has
markets,
all the sizes you need.
You don't need a physical delivery.
Even when LME wanted to do it, and you probably would know better, they had to have physical inventory in certain locations, which also didn't work because they say, yeah, I have the steel in Iskenderun in Turkey, but I need it in Romania. So
in the U.S., you have financial markets. You don't have physical delivery.
Oh, okay. Well, that's a different world.
I don't need to be a defender of Peter Markets.
Julian, sorry.
He can defend himself. I think that, I hear a lot of resistance from the table there, from the chair's table, and having been battling away myself for many years to drive derivatives forward, I can see it's still very, very tough to get the concept across, and it's also tough because it's still quite high cost. But there's no doubt about it. It's certainly done. It's been a good thing for STEMCOR, which means it's been a good thing for some of our clients and some of our suppliers. But it's still so small compared to our turnover. It would be maybe 1% or 2% of our turnover today. But if you look, for example, or talk to the big metal traders, they look at the steel people as if we're just mad. They look at us and say, you can't completely hedge your risk. You haven't worked out exactly what's happening at any minute of any time of the day in all these aluminium and copper smelters like we do. In the steel business, you've got no idea. They have a much more sophisticated approach. And, you know, you're right. People were saying 20 years ago, Willie, that things are going to change in steel, and Ralph would always talk about disintermediation and things. But, you know, here we are. We've got droids now dropping, or drones or whatever they're called, parcels in your backyard. Things are changing, right? Maybe in our little space they're not changing as quick. But I'm quite comfortable that hopefully, as long as I last in the steel trade another 10 years or so, which I certainly intend to, that we'll see a significant increase in the amount of futures contracts in steel, which would include rebar. But scrap, as Peter's said, is one of the better placed contracts because it's easier to get hold of, it's easier to deliver, and then what you try and do is you relate what you're selling to the scrap price. The problem, as you say, Willie, is particularly, you mentioned you've then got to deliver the contract. And if you've got a market where certain suppliers hold things back or won't deliver, that adds to complications. But these things will change because people in the end will have no choice, because at the end of the day, a producer has to sell, and the person who has the money can ultimately dictate who's they're going to buy.
If you bring it down to the scrap level, it can work because scrap is scrap, and you can produce any type of steel with it. But once you go to the next level, billet, it gets harder. But really, because then you have different qualities, and you go further up the chain, it gets almost impossible.
But the idea of this with the scrap contract is something that should work, and I agree with Peter because it's a very liquid market. And we all know from the slides that we saw this morning about the margin in between scrap and rebar. So let us say that over a period of 5 years, it's ranged in between $160 and $220. And if we can buy scrap futures 6 months into the future and we earn a profit on that, then we can take home that profit, and then we can afford to pay more for the rebars from the mill that we're obligated to supply our physical product to 6 months into the future. But that works as long as the mills have always extra capacity to supply, because they can maybe sell out their production 3 months in advance to their own customers, and when you show up and you want to pay the market price for the rebar, which you're able to do because you have that profit from your futures hedge on scrap, they may not be able to supply you, and then you're stuck.
And Julian, I'm with you on products which are standardized, like wire rod, 1008, 1010. Okay, everyone is producing more or less the same product. You have no other standards. But on rebars, believe me, in Europe, I have a big concern that this can ever work. I mean, British standard, German standard, you know all that. I don't have to tell you. So. And to put this together and to expect a physical supply from anywhere, this is certainly the last product I would see to be hatched in this respect.
As far as the grades go, my whole career has been spent in the commodity business. And if you go back to 1982, when the New York Mercantile Exchange introduced a crude oil contract, people in the industry said, oh, it can't be done. There's 250 grades of crude oil. How could you possibly get one futures contract that's going to work for everybody? Well, they did. I mean, they wrote the rules a certain way, and as a matter of fact, if you look at all the commodity markets, if you look at the corn market, it's not one grade of corn that gets delivered to one silo somewhere near Chicago. There's all kinds of adjustments that get to be made down the line. So, and the same thing would be true with the steel scrap, or with any product that you're going to translate. Say you're going to hedge your rebar against the steel scrap. Well, you come up with those terms. The exchange doesn't have to. You say, okay, I'll do this. I'll trade my rebar with you, a physical rebar with you, based on 80-20 contract on the LME or our contract on the NASDAQ. And we'll build in certain allowances, and we'll make certain adjustments on some kind of algorithm. But you guys are the ones who determine the physical relationship to the futures contract.
We kind of do that when we have alloy surcharges we use.
Yep.
But what we do is we say, here's my price for October, subject to the alloy surcharge and subject to, let's say, sometimes transportation surcharge. We kind of do that, but we really, other than that, that's where we limit, you know, because we are using the, let's say, Metal Bulletin, you know, data for even, let's say, the pricing on certain products, and we can, when we go forward to like October, I mean, let's say more than 6 months, but within 3 months, not much changes. But when you go over 3 months to 6 months and all that, we do use those indexes, and that's what we have to do because those indexes do change and will make a huge difference on the pricing.
Well, you know, there's just certain advantages to using futures market, like for the scrap people. Yeah, we all get, if you think the market's going up as a scrap trader, you lay a little bit more down on the ground, right? You just buy extra, and you, well, maybe not you, but scrap traders in the you know, generally, if they're bullish, they buy some extra, and they have to pay for that, and they can't even finance it without a futures market. But if the market's going down, they don't really have many options. I mean, if I know the market's going down, I don't even know what they do besides sell.
On scrap, it makes perfect sense. And like I said, I never understood why they didn't utilize that for scrap, because it's just a basic thing.
Yeah.
I mean, there's only three, you know.
I agree with you that that the local markets, the regional markets, you can't use a U.S. hot roll contract to hedge European hot roll. It just doesn't. I get it that doesn't really work. But
maybe the seller makes more money with the uncertainty. Maybe that's some, you know, other reasons for that, because really for the mills to have a steady supply of, or at least they know what they're doing, it makes a lot of sense.
But also,
it's not occupied.
I'm just telling, this is anecdotal, but I've been in the futures industry my whole life. My father's been in the futures industry his whole life. When I tried to explain to him that in the United States that there was no way for a manufacturer of a product that's made of steel, that there was no way for him to lock in a price month to month, he couldn't get his head around it. He didn't know what I was talking about. He grew up in the copper business and in the ags, and he traded everything. And he did not understand how somebody who makes washing machines or somebody who makes lawnmowers can't get a fixed price for a year on his steel. I swear to God, I mean, it was like, Dad, he just doesn't, you know, this is a floating price. And he just really didn't get it. So why are we different than everybody else, I guess is my point, my question.
But maybe it's also the industry itself. And I remember when we had a discussion on a rebar hedge, there was a spread of around 30 euros, where the customer of today's price, and he had to pay 30 euros extra in order to have a fixed hedged price. And the guy looked at me and said, Mr. Alf, I need a price which is 20 euro below that today's level, because I've sold my cut and bend rebars at such a price that I cannot even afford today's price. So I'm speculating on something which I don't have yet, but maybe at Christmas time when nobody is awake, I will buy the steel. So maybe it's also a different type of mentality in that trade, and it's not a producer like a dishwashing machine producer who needs a regular price level to calculate his dishwasher. So it's a different sentiment and a different environment maybe, and the people are reacting very, very strangely.
So let me add another perspective. How many billet sellers are there in Russia, Ukraine? 5?
Yeah.
Builders?
Billet.
Billet.
How many mills are selling billet? It can't be that many.
15. No more than that. You're right.
And a couple in Europe, maybe. So your problem is that is a product prone to a sale directly from one producer to another. So it's a bad product because even if you have a futures price, you can't be sure there's going to be a supply. But in scrap, You always have supply. You got thousands of buyers and sellers. So that's, and then you can relate that to the price of billet, and you, whatever. But so that's what the problem in billet, it's not liquid. Slab is not liquid. You can't have an index on slab. Graphite electrodes, this man this morning who's brilliant, you know, he's having these daily prices, but that industry is an incredible oligopoly outside of China. How are you ever going to have a price index when you only have 3 main producers of a product? You can't have it. Because they set the price.
You need lots of integrity.
What's that, Michael?
You need lots of integrity. Honesty. It's difficult.
Julian, any further comment on that, or?
No, not really. I think we've done it.
Yeah.
Thanks. So, coming to the next point, what are the current problems and financial casualties on the U.S. steel traders? John, you are one of those.
Yeah, well, I don't think we have financial. Actually, U.S., you know, we have too much money with the banks, and they're trying to loan you money as much as you want. So we don't have any, you know, issues in financing at all. Yeah. Really, it's right now. I'm sure it's almost the same thing is true for Europe as well. There's too much liquidity. Yeah. With the financial institutions. They all have money, so they're willing to give you money as long as you can pay back.
With those interest rates.
Right, and very low interest rates too.
So the last question and last point we got from the audience is the forecast and intelligence about construction market demand supply balance in each major region for the years 2018, 2019. So then it was listed Latin America, Central America, Europe, Middle East, Africa, Southeast Asia. Maybe, let's start with Latin America, maybe 1-2 sentence.
Well, from the presentation of CELSA this morning, they informed us that Argentina was the country that was going to grow the best in South America. Latin America, Mexico is running at around the same pace as the United States, up somewhat 2.5% on construction activity. Venezuela, basket case. Brazil, tremendous difficulties as well there. And Peru, I think, is doing well.
Hussein, on Middle East?
Middle East. In 2018, we don't see the Middle East market is going to be different than 2017.
He's supposed to do it, but he doesn't.
Okay. Can you hear me now?
Yes.
Sorry? Okay. So in 2017, the 2018, now is that clear?
Yeah.
Okay, great. So we don't expect a better market condition in 2018 compared to 2017 Middle East. The Middle East, as you know, it became a regional market. So the most of the producer is right now is ready to comply with the local requirements. And what we have seen that usually in that region, the trade is being done rather than importing the material. The importer, they start to import or they start to buy the material from the producer in that region. So especially in Saudi Arabia, we see that the government projects came down. So we don't see the demand that we used to see the demand in 2016. If I give you the example, in 2016, the quantity that we sold as Turkey to Saudi Arabia for rebar was about 1 million ton. But in 2017, it's about 50,000 ton. So because the local producer since there is no demand, I mean, there is no sufficient demand in the local market, the local producers' production was enough to comply with the local requirements. And since, as you know, also the local demand in that area, in Middle East, also was slow. So the Middle East producer, they start to export their production to mainly to Southeast Asia. So even as you know, the Saudi Arabia government also removed the export ban. So right now, even Saudi Arabia is ready to export their material as well, which they have already started, even to Singapore, Hong Kong. And for the demand-wise, we believe that in 2018, it's not going to be better than 2017 in Middle East. And we will be more seeing the local producers in our traditional markets, such as Southeast Asia, like Singapore, Hong Kong markets.
Well, coming to Europe, Europe is getting quite robust over the last, I would say, 12 to 18 months. Especially Germany, Benelux, and France are really showing quite nice numbers of increased consumption, up to 3.5–5% year on year. We have still huge infrastructures, especially in Germany, but also in the Netherlands and in Belgium, moving on. So the market is very good for cut and benders. The only point is that still the prices are not as someone would like to have those, especially for cut and bend. So on the other side, competitiveness of producing mills is also still there. On the other side, what we also see in regard of the safeguard is that looking into the numbers, you see that Europe has imported over the last years always between 1.2–1.5 million tons of rebars from abroad, from third countries. And that never changed, even now with the increased demand. And so it just has really no impact, and it would be probably wrong to put any safeguard measurements or even quotas in place. The same happens on wire rod, where we also see that almost over the last 5 years there was a constant supply of 2 million tons of wire rod into the European community, which only slightly increased in the first quarter of this year. So the only weaker point we have identified right now is UK market. Because of the Brexit, it looks like a lot of projects have been taken off, or at least are on hold. Not sure, Julian, if you can agree to that, but we hear that UK market is definitely with less demand than the years before. No. So any comment to Middle East, Africa, Southeast Asia?
The eastern part of Africa, Ethiopia, Kenya, Tanzania, are really booming, 6–8% increases. And so it's a very bright spot in Africa. Also on the west part of Africa, there is a new customs union being put together. It's already drafted, it needs to be signed. But it means that the steel will be going back and forth on the west coast of Africa without any duties, which will most likely spur consumption there in that area, if the steel is made in that area, obviously. In Africa, in the northern Africa, well, Algeria is the one that's adding the most capacity in Europe, or in this area presently. So that will be an interesting dynamic to follow starting in 2019, when maybe Willie here will be selling Algerian rebar in northern Germany. Who knows?
Who knows? Who knows?
Things will change. South Africa has new government, and we're hoping that the economy starts to pick up down there. So I think Africa overall should be considered a bright spot. And concerning Southeast Asia, there we have had a good run, and it probably will continue, all depending, of course, on what the Chinese situation does.
All right. So that was the last question we got here from the audience. So if you have here right now any other question to come up with,
Or any other thing that you
or any other thing, yeah. If not, okay.
India was left off there.
Whatever happens, I think it is the trader who is always, whatever happens anywhere in the world, either on raw material or on the production unit, on the demand or the supply, is the trader who holds, I think, everything together. And they're all here today. Two, I saw in the earlier presentations, the trade as a percentage of the total consumption of steel, how it will be moving in next 2-3 years. I don't know whether it has come up in anybody's mind, but I think the impact of the last 2-3 months, or rather I'd say 4 months, have really affected the trade. Few things have been talked about hedging. I don't know how it will happen. But I think there is a time coming where the traders have to come and put few things together. How situations such like sudden announcements, whether they are political, environmental, and others, are going to impact in the near future. Something must come out. Second, I heard about linkages of, Peter said, scrap is a natural product and billet is not. Somebody will say debar is a natural product and scrap is not. I think they're all linked. And there is no economist who has ever tried to link a formula for a price, say if it is X, if it will be, what will be the Y. People talk about the spread, but there has to be a linked. If the price of scrap is this X, and then in this region, it will be billet Y, the debar Z, and so on and so forth. I think that must be worked as a universal formula. Whether it is possible, I don't know, but it will solve many problems for the future. Thank you.
Thank you. All right. Yeah, then I say thank you very much for your participation, and wish you still a good stay here in Warsaw, and hope to see you again next time in Istanbul. Thank you.